Hello, everyone. This is Florian Munsch. I'm here for Mining Scout and Goldgeld Welt. And today I'm joined by Jordan Trimble. Jordan is the president and CEO of Skyharbour Resources, a uranium company listed on the TSX Venture Exchange in Canada. And my guest is today talking a little bit about the uranium market in general with me, and also give you an update on the company. So Jordan, good to have you here again.
Great to be back. It's been almost exactly a year, and what a year it's been. Lots to talk about, lots to unpack.
Yeah. We talked about it pre-recording, so all the COVID times are behind us. It was exactly 1 year ago at PDAC where we talked about it, and there has been a very interesting development in the uranium market and from your company as well. So let's start with the uranium. So what's the news there?
Yeah, so I mean, look, if last 12 months since we last spoke or did an interview, a lot has happened. At this time last year at PDAC, we were, talking about the supply-demand fundamentals, and which, still to this day are incredibly compelling. I think the most compelling of any commodity or any metal out there. You've had a major supply-side response play out over the last several years. As we spoke about a year ago, originally it was from the low uranium price environment, just mines not making money, project deferrals, production curtailment. But in the last 12 months, and almost immediately after PDAC last year, we saw some major supply cuts in response to the virus. And at one point in April, we saw almost 50% of primary mine supply offline globally for this metal. So that's just shows you the concentration of the primary mine supply globally and the risks to the supply side when there is a black swan event like we saw with the pandemic. And that led to almost an immediate price rise in the metal price and the spot price, where we saw it trading in the low to mid 20s. It traded up quickly through the spring and summer of last year, peaking around $33 to $34 a pound. It settled back in the high 20s. But I think the important factor and note here is that the risk to the supply side far exceed the risk to the demand side. We've seen a relatively negligible demand side hit. And so I think going forward, people need to remember that when you do have these supply disruptions, as we've seen, they have an immediate impact on the market. Now, just more recently in the last 3 or 4 months, we've seen a pretty notable rise in the equity prices and valuations. I think this is, coming from a rock bottom. So I don't think it's overdone by any stretch of the imagination. I think it's still the very, very early innings. But what's interesting is you haven't really seen much of a move in the underlying commodity price.
I noticed
and
that.
So I think a
kind
lot
of a disconnect.
Yeah.
So the last couple of months, nearly all the uranium companies were performing very, very well, whereas the uranium price, at least the spot price, was relatively flat or declined a little bit from the highs before.
Yeah, and I think this is a case of the equities leading the underlying commodity, right?
Okay.
So what you had, it really started in the fall of last year with around the time of the U.S. elections, with Biden getting in, his $1.8 trillion climate change budget and proposal. You had nuclear and the SMR, development of SMRs addressed in that. You had a few other kind of notable announcements and developments around that time. This is all in the, in this bigger macro trend that we're seeing of countries trying to go carbon neutral. You've had major announcements out of some of the largest nations in the world, including China and the US and countries in Europe, that they intend to go carbon neutral or have carbon neutrality in their electricity grids by 2040, 2050, 2060. So over the next several decades. And what the world is waking up to is the simple fact that you cannot do this without nuclear energy, period, end of story. And more recently, you've had business leaders like Bill Gates, Michael Burry, and others that have come out and recognized and talked about this and have made investments into the nuclear industry and into the uranium mining industry, which provides the fuel for these nuclear power plants. And just recently, you saw the new 5-year plan out of China announcing a 20 gigawatt expansion from their current nuclear output. That's a significant amount. They're trying to get to 70 gigawatts by 2025, and they have aggressive plans over the next couple of decades. Other countries globally as well, with similarly aggressive rollouts of their nuclear program. So what's happened is that the sentiment around nuclear energy, and as a result, uranium mining has improved drastically, I'd say, in the last few months as the world is waking up. The investment community, the ESG investment community is waking up to the simple fact that you need nuclear to go carbon neutral. It's great driving electric vehicles and being environmentally conscious, but there's no point in driving a Tesla if it's powered by coal power, right? So, you know, just to have this, to have these goals met, you will need to see nuclear continue and probably more an increased role, play a role in the carbon neutrality that we're seeing happen globally. And so it started with the US election. We started to see more investor interest in spite of the commodity price being relatively flat. And then just, over the last several months, we've continued to see more and more positive headlines around the sector. Now, all of us that have been in this space for many years, we've been predicting this or calling this, it was always in our minds a question of when, not if. And I think the day is finally here. And I think just getting back to the supply demand fundamentals, where you in 2020 had about 180 million pounds of annual demand for reactor requirements, you only had about 120 million pounds of primary mine supply. So a significant supply deficit that's formed. This is just going to continue to add fuel to the fire, and you will, I think, eventually see this another price breakout with the uranium price. I think what could be the catalyst for that in the near term could be physical holding companies like Yellowcake and UPC buying material in the market, as well as producers like Cameco and Kazatomprom having to continue to buy material to meet their ongoing contract requirements. And I think that could spark the next move higher. But ultimately, what's going to be the biggest catalyst and driver will be this new utility procurement cycle, a contracting cycle. We know that a significant amount of their requirements are uncovered from 2025 to 2035. They are going to have to come back to the market and start normal contracting like they have historically.
Yeah. And the long-term contracts are going to roll over one after another. So then there needs to be new contracts on sustainable prices. So
absolutely. And just a quick note on that too. There have been other secondary supplies or inventories that they've been able to draw down from. But again, we're now several years into this pretty major supply deficit, and so that only lasts for so long. These other sources of uranium that they've been able to tap into won't last forever. And I think we're already starting to see that, in particular on the spot market, where we've seen the market tighten up. Just in the last 2 years, 2019 and 2020, we saw each year around 90 million pounds transacted, a major years in terms of volume. And just over the last, in January, we only saw 2 million pounds transacted. So we're starting to see that market tighten up. And so as that market continues to tighten up, and as you have physical holding companies buying, as you have producers buying, I think you're setting the stage for a pretty rapid rise higher in the spot price, which I think will then help to facilitate new contracts at higher prices. Because at the end of the day, what's happened is there's been a stalemate where the utility companies they tried to get best price using the spot price as the bellwether to negotiate a lower price contract. And the mining companies have said, look, we're not selling our production at these low prices for 5 to 10 years.
If you make a loss on every pound sold, why should you do that?
Exactly. And Cameco has exemplified this perfectly, where they've simply shut down production. And they've said, look, we'll just wait it out. We'll buy material in the spot market. We'll make money that way, and we'll wait till we have higher prices, and then we'll look to contract at higher prices.
About the shutdowns, Jordan, I think this is a very crucial question, and I talked about this with many industry leaders in uranium before, except beside us. And so the question is, how do the supply demand fundamentals really work? Because if a company decides to cut a supply, how fast can it be resupplied to the market? I know there's a difference. For example, the Kazakhstan ISR projects, for example, which have higher economics than other projects in the world. But how fast can companies and projects be ramped up again and maybe oversupply the market again?
Yeah, I mean, okay, so if you look at, the production that's come offline, in particular in Canada and, to a certain extent in Kazakhstan, where they just simply extended that 20% production cut that they had announced several years ago. With all of these mines coming back, like McArthur and Cigar, now McArthur I think is going to take longer. Cigar has been offline more recently because of the pandemic. That can restart quicker. But even when you add these production centers, these mines back to the global production profile, you still have a shortfall. You still have a primary mine supply deficit. If you look at the numbers in 2015 and 2016, you had about 150 to 160 million pounds of primary mine supply, again, in the backdrop of 170 to 180 million pounds of demand. And so, we saw these major supply cuts in 2020, a good chunk of that because of the virus. But even with the restarts, you still have a primary mine supply deficit. You're still having to draw down inventories and have secondary supplies meet that gap. Now, as far as the restarts go, like I said, I think Cigar can restart relatively quickly. I don't think it's going to be as easy to restart McArthur, which has been mothballed now for several years. And then if you look at Kazatomprom, one of the big issues that they had last year was they were unable to carry out any meaningful well field development. ISR operations need continuous capital and sustaining CapEx to maintain or increase their production profiles. And Kazatomprom was unable to do that for the better part of 2020 because of the pandemic. So I think there's a good case to be had that, that the production profile and amounts in Kazakhstan may not just continuously increase or stay the same, and that there could be declining production over the course of the next decade. There's lots of uranium there, but keep in mind, typically when you are operating a uranium mine, whether it's a conventional mine or ISR operation, you typically do mine the higher value ore earlier on. And so, it's yes, there's lots of uranium in the ground, but it is a matter of, how much does it cost you to get out of the ground, right? And so, you don't have these big mega mines that are currently operating that are going to be operating for another 20, 30, 40 years. And you do have to see new production and pipeline projects being developed to meet the growing demand. The issue is that because there's been such an underinvestment over the last decade, a lot of these larger pipeline projects they're going to take time to come online. And I think we're setting up much like we saw in 06, 07, where you saw a pretty dramatic increase in the uranium price as a result of a kind of a confluence of factors. I think we're setting up for a similar scenario where you've had this supply side response play out. You have a new contracting cycle looming with the utility companies, and you're starting to see sentiment around nuclear energy change, and you're seeing that result in higher share prices. So I think it's a kind of a perfect storm, and one that we've been waiting for a number of years.
Yeah. Okay. Let's talk about Skyharbour Resources. So the company is one of very few exploration and development companies left in the market for uranium, and you are located in the Athabasca Basin, so the richest area for uranium in the world, and you have a very unique business model. So you are a prospect generator. We know that from gold, for example, but in uranium it's really unique. Talk about this and maybe give investors an update about what happened in the last year.
Yeah, so first and foremost, we are a exploration and discovery story in the Athabasca Basin, again, the highest grade depository of uranium in the world. 6 projects at various stages of exploration. 2 of them have deposits. Our flagship project, Moore Lake, which we spoke extensively about a year ago in our last interview, that's the focus for us. That's where we spend our money in the exploration and early stage development activities. That's really the key value driver for the company. We've done a lot on the project since we did the last interview, including several drill programs. And as we spoke about last year, the focus on that project has shifted to exploring in the basement rocks, where the geological setting where most of the recent high-grade discoveries, like those made at NextGen's Arrow deposit, Triple R for Fission, the Griffin deposit at Denison's Wheeler project, and several other more recent discoveries. These underlying basement rocks haven't been systematically drilled or explored. Most of the historical work was focused on sandstone and unconformity hosted deposits. So we carried out several drill programs last year, and just recently in the last several months announced results from our last drill program, where we intersected the longest continuous width of uranium mineralization, a 17.5 meter zone of 0.72% U3O8, and within that 10 meters of 1% U3O8. Now, this is all hosted in the underlying basement rocks at what's called our East Maverick zone. So it's this conductive corridor, 4.5 kilometers long, on our flagship Moore Lake project, and it's a perspective corridor. There's 2 high-grade lenses at the Maverick and East Maverick zones, and what we've been doing is looking a little bit deeper into the underlying basement rocks, into the feeder zones for these high-grade zones. And just in this last program, looks like we've nicked the side or the top of something much larger and potentially higher grade. So upcoming drill programs that we're fully funded for, that'll start here in the next several months, will further test that, and we're excited to see what's a bit deeper in the basement rocks. But we also have other targets along strike that are relatively shallow, and regional targets at the project as well. The project's located on the east side of the basin, so it's proximal to roads, power, mills, and other mining infrastructure. Our plan is to continue to advance it and hopefully make additional discoveries, continue to delineate resources there. We are working towards a maiden resource estimate towards the end of this year, once we've completed these upcoming drill programs. And then, as you pointed out, our second part of the business is prospect generation. Because we've amassed such a large dominant land package in the basin, over 250,000 hectares of property scattered throughout the basin, it makes sense for us to find partner companies to come in and advance the non-core, the secondary projects. And I think
this really has to be highlighted, because exploration is a high risk, high reward business. And if you can give some of the potential reward away and reduce risk in, for example, because partner companies are exploring your ground and spending money there, you have maybe a less dilution and less risk, actually.
Exactly, and that's a part of why we became I'm not going to say the core business being prospect generation, but a secondary part to the business being prospect generation, because we recognize that, it's great having a large land package, but if the projects are just sitting there collecting dust, it doesn't create any value for shareholders. And so we set out in 2017, and we completed 2 transactions, 2 option deals with 2 partner companies, one of which is industry leader Orano. At our Preston project, they can earn up to 70% They can earn an initial 51% and then can earn up to 70% by spending $8 million, most of that in exploration expenditures. Shortly after that announcement, we had a second partner company called Energy, which has had some success recently, and they're currently drilling at our East Preston project. They've actually now completed the 70% earn-in at that project, so we carry on as a joint venture partnership. They have 70%, we have a minority interest. We benefit with any success that they have in the field with the drilling as a shareholder of the company and as a minority interest holder in the project. So excited to see what they can pull from that program. And then just recently in December, we announced a new property deal with a new partner company, ASX listed Valor Resources, based out of Perth, run by a very capable and strong management and technical team. We've optioned the northern half of our Falcon Point project to Valor Resources. The project consideration is around 4 million, just under 4 million Canadian. The bulk of that in exploration expenditures and some cash payments over a 3-year period. We also now own about just over 233 million shares of the company. It's valued at about 1.6, 1.7 million Canadian. And again, they will fund the exploration at this project over the course of the next 3 years, earning in an 80% interest in the project. We just announced last week with them an initial multi-phased exploration program for 2021, starting with some geophysics and then phase 2 program in the summer consisting of some field work, and then ultimately working into an inaugural drill program later in the year. And what's interesting about this project is that the main target is called Hook Lake, and actually the project's name is going to be renamed to the Hook Lake project. But the Hook Lake target at the project area is a very high grade, massive pitch blende vein at surface. We've had some samples return there as high as 68% U3O8. So it's a bit of an enigma because you have this incredibly rich outcropping uranium mineralization, but the source rock and the source structure for that has yet to be discovered. So it's a great target. We're excited for them to go and properly explore that and see if we can find the source for that very rich mineralization at surface. But again, getting back to the bigger picture and the strategy here, this allows us to focus our time, money, and efforts at our flagship Moore Lake project, while partner companies fund the exploration at these other projects. And again, we retain upside potential in the event they have success through shareholdings in the company and through a minority interest, ultimate minority interest in the project.
So you've said it before, you will have probably have a maiden resource estimate by the end of the year, and exploration will be carried out by your partners and by yourself. So lots of potential news flow coming, and for interested investors for Skyharbour Resources, we are covering the company on Mining Scout and Goldgeld Welt. And if you want to know more about the company, look it up at the TSX Venture on the symbol SYH. Thank you very much, Jordan.
Thank you. Great catching up.